The US housing crash has already started, and it is getting worse by the week and by the day. If you look at certain cities in America right now, whether it be in Austin, Texas, a Phoenix, Arizona, or a Boise, Idaho, inventory on the housing market, the amount of homes for sale has spiked 300 to 400% in just 4 to 5 months. And we were actually already seeing home prices go down month over month in many of these markets. And so this housing crash, don't be fooled kind of by the mainstream narrative that, oh, it's just a softening. No, this is underway, and it's going to continue to get worse over the next several months as the recession in America continues, and as we have a backlog of foreclosures, and as home builders now deliver a record number of homes that are under construction.
All right. Wow. I want to pull at each one of those threads individually, but real quick, why don't we just start with sort of your general assessment of the current valuations in the housing market, right? So our starting point here, if we are entering a correction, how potentially overvalued is the current market, do you think, from what you would consider to be fair value?
That's a great question. And the answer to that question really depends on the city that you live in. I have certain cities that my home price model is projecting a 40% peak to trough home value decline. And some of those locations are already down by close to 10% in just a couple months. So it really depends on the city that you live in. There's certain areas in America where this housing crash is going to be brutal. It's going to be very similar to what occurred from 2007 to 2012. There's going to be other locations that aren't hit as hard, but zooming out more broadly, I think it's realistic to expect that home prices across America go down by 20% on average. But like I said, up to 40% in certain cities and maybe only down by 5% in other cities.
All right. Let me talk about that 20% for a second, because I've heard people say, because nationally, sounds like housing market, a few months back, reports were coming out that the housing market had increased by 20%. Year over year. So, I've seen a lot of people just sort of shrug their shoulders and say, what's a 20% correction? It just brings us back to where we were at the beginning of 2021. It's no big deal. What do you have to say to those people?
Well, those people are wrong. It's a huge deal. The first thing you need to understand is that lots of people bought their homes over the last 2 years. In fact, I think around 15% of current homeowners in America have purchased their home over the last couple of years. So that means a lot of people are now going to be underwater on their mortgage as home prices decline. And that's going to lead to foreclosures. It's going to lead to defaults. It's going to lead to a negative wealth effect across the economy that's going to lower consumer spending more broadly, which is going to make the recession even worse, and that's going to cause home prices to go down by even more. So the broader thing people need to understand is that housing is a massive asset. Its value is $40 trillion. It's even bigger than the stock market. So when housing goes down, that's historically something that propels the overall economy into a nosedive.
Yeah, well, it absolutely does. And I've mentioned this in this program a lot, but financial assets, stocks, et cetera, they are, it's something like 90% of all those assets are owned by the top 10% of households. So they're not that well distributed across society. So what happens in the stock market, even though we hear about it in the media a lot, it doesn't really impact the daily experience or behavior of the vast majority of America. But something 60%, 2/3 of American households own their homes, are homeowners. And so what happens in the housing market is much more influential in terms of a wealth effect, or in the case of declining home prices, a negative wealth effect than the stock market is. So I'm really glad that you brought that point up, because we really do have to watch the housing market, because what happens there tends to drive certainly consumer purchase behavior much more than what happens in the stock market.
And a great thing to add to that point is just think about Zillow. Like, now a homeowner can go on Zillow and check the value of their home every day and every month. And we've had tens of millions of homeowners in America over the last 2 years going on Zillow and saying, yay, my house was worth $500,000 a year ago. Now it's worth $600,000. Now it's worth $700,000. Oh my God, I have so much equity. Let me just go and spend money or take out more loans. Everything's going to be good. Well, now they're going to go on Zillow and they're going to see, the value of my home is now $600,000. What am I going to do? Well, I need to cut back. So just to your point, Zillow and kind of the fast-paced nature of this housing market is something new that we're experiencing in this housing bubble. So that's going to have an impact on the crash that I don't think many people have considered yet.
That's actually really fascinating. Hey, a question about the Zillow estimates, or the Zestimates, or whatever they call them, right? Which is, I'm assuming those are put together, crunching the years/decades of housing transaction data that Zillow has, and then trying to come up with its guesstimate of what your house is worth. And I'm curious if those things tend to, put out poor fitting estimates at turning points in the market, because all the data is drawn from the previous trend. And so as the trend is shifting, could the Zestimates people have on Zillow right now be artificially too high given the current change of trajectory in the market, right? Because they don't have enough sales data yet to start adjusting, right? I'm just wondering if people are getting a false sense of security right now from some of these digital home estimates.
Yes, I think that's a great point. So the Zillow estimate is a lagging indicator, and they actually report two different types of home values when you download their data. One is a seasonally adjusted figure, one's an unadjusted figure. And that seasonally adjusted figure is only showing kind of moderate declines in home prices. But when you look at the unadjusted one, which is more real time, we're seeing in certain markets, like in the Bay Area, home prices are already down 10% in just 2 to 3 months. And so I actually think, there's quite a few people already seeing that lower estimate, but your point is correct. There's a lagging indicator, whether you look at, the Zillow home values or the Case-Shiller home values, which are reported about 3 to 4 months backward. We're not going to see probably until the fall, kind of the reality dawn on many people that, oh man, home prices are now down by 5 to 10% already in just a couple months. And that's when, the housing market crash is going to get even crazier, because there's still certain people who aren't really acknowledging what's going on. Like when I look at a market like Phoenix, Arizona, we've seen inventory more than triple in the last 5 months. And now home prices in Phoenix are down by 5%. And now we're seeing a wave of evictions hit the Phoenix rental market, and many investors are now selling out of the market. And so that's a market that's crashing, but many people don't know that Phoenix is crashing or that Boise or Austin's crashing. And that's something that's going to be picked up by the mainstream, I'm predicting, in the next 1 to 2 months, which is going to turn sentiment even more negative on the overall housing market.
All right. So folks, you're hearing it here first. Nick Gerli, the housing market is already in a crash. And that's just going to, that'll manifest in the headlines within a month or two, but you're getting the news right now, straight from the horse's mouth. If you enjoyed this video clip, click here to watch another one you should like.